Welcome to episode 4 of the Monday Having.
Hey
today we have another special guest, Jason Rasmusson. Jason, tell us a little bit about yourself and why you think we brought you on today.
I'm not 100% sure why we're here today, to be honest with you, but hey, I appreciate you guys having me. So I've been in the mortgage business for the last 30 years. I'm one of the branch and regional managers here with Supreme Lending. And
my fearless leader.
Exactly right. I spent 12 years doing MBSs on Wall Street, so it's kind of a little bit of a passion of mine also, but we do a lot of financial planning with our clients. So we do a bunch of different things, put it that way.
Awesome, cool. So the reason I wanted to bring you in here, obviously the Fed rate cut earlier this week, and I think there's just a lot of things. You can go online, you can go on social media, you can go on TikTok, and it's just a bunch of things that I've seen that are very untrue, and then people are just deep diving in multiple different directions. So I thought it'd be valuable for us to do just a quick little Q&A and be like, for somebody who's been in the industry since what, you were 16?
Yeah, well, actually
16 years old.
13-ish, but I mean, who's counting?
Oh, wow. It's wild.
No.
I want to know.
And he's 75, y'all.
And I'm 75. So it's been a long time.
It's been a long time. On that, just my curiosity, what drew you to it? What was that passion behind wanting to go into lending?
Well,
he's a freak of nature.
No. If I'm being completely honest, I had absolutely no idea what I wanted to do. And my dad was in the banking world, so he suggested right as I got into high school that, hey, you need to go work at a bank as a teller. But they wouldn't hire anybody until you were 18. So I walked into a couple of banks a couple of months before my 18th birthday, tried to get a teller job. Nobody wanted to see me. And one of the banks I was in, there was a lending department. So the branch manager of the lending department came out. He's like, hey, we need somebody just as an assistant. When can you start? So once I told him I was going to be 18 in about a month, he goes, we'll see you back in a month. And so I lucked into it a little bit. Now, once I got in, I loved it. And I really thought it was a cool profession, and I enjoyed the work. And so I just stayed with it and put myself through college doing it. But I really just fell into it, to be honest with you.
That's awesome.
Yeah.
So with that, over the years, from what you've seen, what the Fed's doing and the whole debacles, because you've lived through a bunch of stuff.
Oh, yeah. Late 90s type of stuff. And then we got into the Great Recession. Yeah. So it's been interesting.
So how would you correlate to what we're currently experiencing now to what the actual media portrays it as?
Well, to be fair, the media is off their rocker on a lot of stuff. I mean, I don't know if we can get away with saying that or not, but that's the reality, right? So it used to be you didn't have the media presence that you have today. And so what happened was the Fed did all their stuff in the dark. You would read about it in the Wall Street Journal, basically. In fact, for years, we had to have Wall Street Journal subscriptions in order to really figure out what was going on. So now everything is covered, and it's mostly covered live. So you can literally see and hear everything that they say. And it's, number one, so much more transparent than it ever used to be. You know exactly what they're thinking. They give you all the answers. But number two, it also leads to overreactions. And that's the number one difference I see today versus years ago. Even 10 years ago, the Federal Reserve did not do a press conference after their meetings. Wow. So you had to read the minutes, which don't come out for a week or two.
And how many people are really reading those, right? Like
nobody.
7 in the entire country.
Exactly. The true Wall Street guys are reading it because they want to know what's going on. But you're 2 weeks past the Fed decision at that point. There's not really a lot of room for overreaction. And you definitely didn't hear it right out of their mouth immediately. It was just a press release that said, hey, here's what we're going to do with rates today. So I think the number one difference is you get so much access and so much information. And because of that, just like anything else we do, we overreact to it.
Okay.
And so how would you compare this rate cut to every other rate cut that you've experienced, which I'm assuming is at least a couple of dozen, if not more, right? At this point, more than that. Well, so, I mean, do you see this just as just another rate cut, nothing extraordinary, just par for the course? Or is this something, do you see an anomaly here? Do you see the timing of it with it being back-to-back cuts? Do you see that being massively different from what you've experienced?
So on the surface, the answer would be no. But now if you pull the curtain back a little bit and you start to realize, when does the Federal Reserve normally cut interest rates? It's not when things are going great. In fact, just to kind of set the table for a minute, when the economy is slowing down, when jobs are slowing down, and we're starting to get ourselves into trouble, i.e. heading into a recession or at least an economic slowdown, that's when the Fed pulls the trigger on lowering interest rates, because what they're doing is trying to stimulate the economy and the job growth, right? Yeah. So most of the time, the Fed is cutting rates into a weakening environment, and they're trying to help us out. Well, what's different about this one is, yes, we've got some things moving in the wrong direction. We've got some slowdowns for certain, but at this point, they're cutting into a strong environment. And that's very, very unique. In fact, I saw just the other day, I can't remember the exact number, but it's only been a couple dozen times in their history that they've ever cut into a good environment, a good economic environment. And in fact, I say a couple dozen times. I think it's only been really like, if you lump the times together, because, let's say they cut 3 meetings in a row, lump those together, I think you're down to like 4 to 6 actual times in
really? Wow.
they've cut.
Why do you think that is?
Positive. Well, so right now we got a couple things going on. So number one, you've got a lot of political pressure. We've never had that in our history, and so that's the first piece of the puzzle. And by the way, the Federal Reserve is supposed to be an independent body. The last time they were not independent was during the inflationary run-up of the late 70s, early 80s.
Oh.
And what happened then was they got a lot of pressure to cut after inflation. So inflation had spiked. They increased interest rates to drop it. It dropped down to a decent level, not quite where they wanted it though, but not a decent level. And they got a lot of political pressure from the White House to drop rates going forward. They went ahead and did that. When they did, it actually reignited inflation, and inflation shot back up. So our peak before they dropped interest rates was like 12% in inflation. The peak after they dropped interest rates was 18, 19%. So the rebound effect was significantly more damaging than the first basic inflation increase.
And that 18, 19%, that was like 82, 83-ish, right?
It was late 70s, early 80s. Yeah. So it was over a period of time right there. So that was the last time the Fed was politically pressured. So fast forward today, we have a very similar scenario playing out. So you have inflation peaked in the 9 to 10% bracket. The Fed wants it at 2%. They've got it down to about 3% right now. So it's way down, but it's not where they want it yet. And now we have a lot of political pressure coming in to go ahead and reduce interest rates because everybody in the administration wants the economy just to roar forward. So the question becomes, and the uniqueness of this rate cut is this going to reignite inflationary concerns, or is it truly just going to give us what we call that soft landing, where we just kind of touch down a little bit on the bottom and then keep on trucking with a good, strong economy?
So what are indicators that like the average Joe can see, like, inflation can now tick up? Or is there anything that you would see out of the norm? What
are the things you look at? Like the bond market, like what are you looking at? Like somebody who's not in the mortgage industry, who doesn't keep tabs on this stuff, what should they be looking for or at?
Well, as far as red flags go, the bond market's a really good one. So let's start with what the Federal Reserve is doing when they lower interest rates, and then let's dive.
Yeah, that'd be awesome. Yeah, perfect.
So basically, the Fed is influeing what we call the Fed funds rate. The Fed funds rate is an overnight lending rate between banks. So if we're both banks and you need money from me tonight, I'll lend you money, and I'm going to do it at the Fed funds rate. You pay me back the next day because you have your liquidity and you're good. That's the simplest explanation for what they're doing. So when the Federal Reserve drops or raises interest rates, for that matter, because they're influencing just that short-term rate, they're not really influencing auto loans, mortgages, etc. Now, what happens is that they're basically giving us suggestions, and they're slightly influencing us by saying, here's the direction that we want to go. And ultimately, if you are charging less on the overnight rate, then the banks can charge less for mortgages and autos too. So it does filter into our world after a while. But in general, we get about 20% of whatever the Federal Reserve does. So if the Fed is going to drop rates by 1%, which they're clearly not going to do right now, that's a huge number, we would only get about 20 basis points in discount on our interest rates in the mortgage business. And that's max. So the quarter that they did this week gives us maybe 5 basis points, 0.05. So let's say rates were at 6.2, now they're at 6.15 on a mortgage. That's not a huge adjustment, but the bond market takes its cue in part from what the Fed's doing. And the bond market does drive our interest rates. In fact, the bond market drives us dollar for dollar. If the 10-year Treasury, which to kind of go back to answer your question, if you want to see what's going on as your normal Joe, go look at the 10-year Treasury. If the 10-year Treasury yield is going up, rates are going up basis point for basis point. If it goes from 4 to 4.10, rates are going to go from 6.1 to 6.2, as an example. Same thing on the downside. If it goes down 10 basis points, we're going to lose 10 basis points on our pricing. So the good news is, A, you can see it in real time and know what's going on. And B, that barometer gives us a really good idea about what the future looks like, because the bond market is 6 months forward thinking. It's a little bit of a strange concept, but what the bond market's trying to tell you is where they think the economy, rates, everything financial is headed 6 months down the road. So at this point, if they think that everything is going to be better, then rates will drop, right? Now, better is kind of a weird term. Better and, not necessarily better is we're going to be rolling, but
subjective.
If they think rates should be lower 6 months from now for whatever reason, then you're going to see the bond market going down. If they think rates are going to be rising 6 months from now, you're going to see the bond market going up.
So how do you see that playing out? Because next year we're going to an election year, midterms. How do you see that playing out?
Well, from the election standpoint,
what
influence it's going to have.
Yeah, and because also you have politicians who will try to do more favorable things to get their constituents back, right?
They will.
But at the same time, what does that mean now for let's say next March we have first-time home buyers?
Yeah.
What could they expect in a hypothetical scenario?
So it's a great question, and the first part of what you said there is 100% right. Politicians or anybody running for office, they want the Fed to be really accommodative heading into an election cycle. And one of the reasons that we have a lot of political pressure right now is that this current administration ran partially on the idea that they were going to drop interest rates. Mm-hmm. The reality is they don't have anything to do with interest rates. The Federal Reserve does.
Right.
And they can try to influence the Fed, but they can't actually tell them what to do. So the first thing is right now, that administration is going to continue to push the Fed to drop interest rates, especially leading into the midterms, because they want to have as low an interest rate environment with as high a growth as possible so that their constituents will continue to vote for them and not hold them accountable.
I love this. So recently I've been seeing real estate agents posting a lot about the Fed rate dropped. They cut the Fed rate, which means lower interest rates for your home, and that's really not the case. And how are you whenever somebody calls you and says, Jason, I heard they cut the rates?
Yeah.
Because I think the narrative when you just go to TikTok or Instagram or Facebook, it's rates are getting lower.
Yeah. Oh,
because I had an agent yesterday in the hallway saying, great news this week, huh? Your rates are coming down.
Yeah.
And unfortunately, I didn't have the capacity or the time to go in and be like, no, that's not really how it works. So how are you explaining to that into like super layman's terms? You did a great job, but somebody just giving you a call saying, hey, I heard rates are going down. Yeah. What do you think?
Well, so the first thing that and look, we're getting phone calls from clients right now like crazy, right? Both clients that have not found a home yet, so they're not locked in. They're going, hey, rates went down. That's great. What's my new buying power? And then clients who are locked in and ready to go, maybe closing in the next couple of weeks, expecting their interest rates to go down. So the first thing we do is just kind of explain to them in layman's terms what we hit on a minute ago. The Fed's really not dropping mortgage rates directly. They're dropping this overnight lending rate, which kind of influences our world.
It's a little bit of a lingering effect, right?
Absolutely.
Yeah.
The second piece of it is what the Fed does. Really, what we're looking at when the Fed makes these drops is how does the bond market react? And if the bond market reacts negatively, like it's done in the last 3 drops. So let me kind of back up. Last year the Federal Reserve started dropping for the first time in several years. Mm-hmm. And everybody was super excited because we get this 50 basis point rate cut. And what we found was the very next day, mortgage rates went up 1/4 to 0.5%.
Which I think is shocking for most people, right?
Absolutely. It went the exact opposite of what everybody was saying.
Yeah.
And part of the reason for that is because the financial market is determining for themselves whether or not they think the Fed should be cutting rates. Mm-hmm. And if they don't agree with it, then they're looking at it going, this could cause us problems. And if it causes us problems, if it causes our deficit to rise, if it causes inflation to come back, if it causes any issues worldwide, then rates are going to have to go back up. And so now all of a sudden, remember the bond market 6 months forward thinking, it's seeing the Fed cut rates 50 basis points last year. And now it thinks rates are probably going to be higher by middle of this year because of the problems that they foresee it creating. So now rates move up, mortgage rates move up. Well, we've got the same thing going on this year. So most people have a hard time grasping that concept. So basically what we're telling them is kind of this. So number one, the thing you have to understand, back to the conversation about transparency now, we know a month in advance what the Fed's going to do. They're great about telling us that. So what happens when the Fed says we're going to start cutting interest rates, you'll start to see the bond market react and move down, yield move down. And what that does is it drops interest rates for you and I in the mortgage space. Now, at some point, though, we get out over our skis a little bit on that, and we probably go a slight amount too far because we really don't know how far they're going to go, and everybody's got some exuberance and some excitement. So you see bond yields probably trickle down a little too much almost every time. And then you get to Fed Day, and on Fed Day, they go, yep, we just lowered rates 1/4. Well, now the bond market's anticipated that it could be at least 1/4, maybe a little bit more. That's the whole out over our skis conversation. And the other thing the Fed's doing from a transparency standpoint is doing a press conference afterwards. So not only is the bond market out over its skis a little bit, but then we get to ask questions. And the Federal Reserve is very neutral, right? So he starts giving us answers like, well, we're not really sure what's going to happen in the future. We're data dependent. You've heard those terms.
Yep. And then so the media takes that and just runs away with it, right?
Well, they do. And the bond market takes that and goes, whoa, hold on. What he's saying is we might not drop rates again next time. Let's go back up and correct, essentially.
Yeah.
So what we saw in the meeting before this one was way out over our skis. Interest rates went down probably 15, 20 basis points too much. Fed comes out, does this thing, and then just stays neutral. The bond market backs up and rates move up. So it's the exact opposite of what the client's expecting.
Mm-hmm.
This week, we saw the exact same thing play out with one slight tweak that we didn't anticipate. So we got out over our skis. We got low again on interest rate. He does this thing, and everybody's like, well, we're going to back up a little bit. But then he does in the press conference, he starts the press conference with, we're not really planning on lowering rates again in December.
But didn't they say that there was going to be 2 by the end of the year?
Well, so that was if you're reading the tea leaves, that's what the world expected. 2 more by the end of the year, which would have to be the October and December meetings. Yeah. But the reality is they come out and start the press conference with, hey, by the way, December is not only not a foregone conclusion, it's probably more likely not going to happen. And that spooked everything. So now the bond market, out over its skis a little bit already, thinks it's out over its skis a lot. And what we've seen is we saw a 20 basis point increase in interest rates immediately, like within a few hours. And the last day or so, we've seen that that's moderated a little bit, but still continued to trickle up. So the net effect is rates are up about 0.25% since that meeting month.
So that leads me to, I guess, a question. So what are you advising your clients to do now? Are you locking them immediately? Yeah. Are you floating them? Are you waiting? Like, what, as a professional, you have a lot of clients. So what are you doing with your people?
So it's a great question. I'll take you back to the previous meeting when they dropped. After that meeting and they came out and did their press conference and everybody thought they're going to continue to go down later in the year, right? So the point that we made to our clients then was, hey, rates, have been lowest that we've had in the year. They bounced up a little bit. If you have a short window here, 2-3 weeks to closing, we should probably go ahead and lock you in just to make sure that your rates don't continue to rise.
Right.
If you have a longer window, 30 to 45 days, maybe what we do is we chill a little bit and we see what the Federal Reserve says leading into the meeting and then make a decision. And what we think will happen is that rates will trickle down a little bit. Well, the reality is they did exactly what we thought would happen. So those people that had that longer runway, they held on. We did locks a little bit later. The bond market rolled over a little bit and went back down. And literally the morning of the Fed meeting this week, the headline was rates are at their lowest level in a year. Same headline as the 6 weeks prior to that. We were actually even a smidge lower in interest rate. So that's what we told everybody at the time. We locked them in, and then we watched that press conference. And as soon as the press conference started with, we think rates are going to go back up, you could literally see the bond market make a reversal, and we locked in everybody we could. Because now we have this December meeting, the rate cut. It may still happen. We don't know. There's not good data right now because the federal government's closed. But we know that the Fed's thinking is, you're going to have to prove to me that I need to move rates down.
Yeah.
Not, we're going to move them down. Now you disprove my theory.
Yeah.
And so because of that, we're no longer saying, well, we think rates will continue to drop into the end of the year. We're on pause, really, I think, like the Fed is too, until the government opens up and we have more data. The problem is that the Federal Reserve has come out and said, we're not just going to pause. We think we're probably just not going to do it.
So you think it'll stay the same?
I think it probably stays the same, to be honest with you. I think what's going to happen is you're going to get some data in. So let me tell you what will influence this first and foremost. It's the jobs report. So the last 3 years, the Federal Reserve has been increasing interest rates or leaving them high to fight inflation. They finally have inflation down to this 3% number, which is still too high for them, but it's tolerable, right? And now you have job creation, which is really slowing down, and the concern that you might even have job reductions coming up. So now that's why they're in this we need to cut mode. But with the government closed and you don't have real jobs reports out, how can they make that decision?
Yeah, the data's not there, right?
No, it's just not available to them. And so what's going to happen is at some point this shutdown ends. When it does, you're going to get some backward-looking data. We'll see what that looks like. And then you're going to get a data point at the first week of December, the first Friday of December for jobs. I think if the jobs are weak, if the current data that we missed comes back in this week, and you have a December number that's weak, I think you're going to get the Fed to cut another quarter.
Wow, which will be 3 in a row.
Which will be 3 in a row. Now, if all that's neutral, I think the Fed's going to pause because their concern is they don't really know where this thing's headed, and they're still waiting to see what the tariffs do and everything else.
So if I have, let's say, a first-time buyer, or someone wants like, hey, Nathan, I want to buy a home.
Yeah.
So what should I be telling my clients in terms of what the mortgage rate looks like compared to what happened and what was announced? What would be something that they can take, like, all right, this is a good time to purchase. It might show a hold. And then what are questions that my client should be asking when they go see a lender?
Yeah, good question. Well, I think the first thing is when we have that conversation today, essentially what we're telling people is this. So number one, our expectation for rates to drop over the next 12 months, excluding a recession happening, a monster recession. If that happens, all this is off the table. But if we just roll along with either low growth or sustained economic growth, then we think rates are going to trickle down a little bit next year. And we probably land somewhere in the mid to upper fives. That's not a huge amount of difference.
But still fantastic. Right? It starts at the 5. We're celebrating.
Yeah, absolutely. Stupid happy. Don't get me wrong. But here's the thing. So to the average regular consumer, especially a first-time buyer, buying a $350,000 to $450,000 home, every 0.1% is going to move your payment by $25 to $40 a month at most. So if rates today hypothetically are at 6.125 and they now drop to 5.875, the consumer is going to feel great because it starts with a 5. But the reality is they just save $50 to $75 a month on a payment. So it's not going to be enough to make them say they can or cannot afford that house. So here's the conversation then. All right, Mr. Consumer, so we think rates probably do trickle down. We think if you sat around, you could save yourself $50 to $75 a month, to be fair. But on the other side of that, the real estate market right now is slow. Sellers are worried. And so what you're seeing is lower initial list prices. You're also seeing price reductions as homes sit. And then when you do get a contract,
less competition as well.
Less competition, 100% less competition. And you do get a contract and you can still go in under the list price and ask for seller concessions in a lot of cases. So what's happening is you get this monster discount on the price of the home for buying at this time right now. And that discount could be in the tens of thousands of dollars, which means that who cares about $50 on your payment? You just saved $150 on a payment by getting a discount off the sales price.
Yeah, because I had a client, we put an offer and it ended up being $25,000 below the list price.
Yeah.
Now it didn't get any concessions, but I mean $25K. That's
and we can't predict. Right? We hope and anticipate the spring and the summer to be a lot busier, pick up tremendously.
Yeah, we do.
I mean, typically, historically speaking, that's when buyers come. The buyer pool comes in, right?
Yeah.
And so I agree, this would be a great time to buy. So it's like the old adage of, you step over a dollar to pick up a penny.
That's right. Yeah. And that's exactly what they're doing. And Nate, to your point, that $25,000 that you got off that sales price actually saved that client $150 to $175 a month. So who cares if you missed out on a quarter rate reduction? You still saved $175 a month on your payment, which is a better deal for you. And by the way, you're still going to want to refi when rates get into the upper fours.
Yeah, 100%.
So now you have the $25,000 cost reduction has been locked in. Like that's permanent. You pay $25K less. And now you also get the interest rate you want, which means that part of the equation comes down too.
Because what I've been telling is like, hey man, right now, the way I see it, we're in the buyer's market. Buyers are kings.
Yeah.
We can dictate, because we can go to the side, hey, so I want you to pay for title, I want you to do this, concessions.
Yes.
Come back March, time of that could flip around.
Well, all right, so let's talk about that. So here's let me back up your thought on that. You're 100% right. Yeah. And let me give you some data points behind it. So since the Fed started raising rates, the last 3 Januaries in a row, we've had, for some technical reasons, interest rates dip a little bit once we come back from the holiday. So 23, 24, 25.
Wow.
In those years, our average rate for the whole year was in the high 6s or low 7s, depending on the year. But in January of those years, we dropped to about 6.25 each of those 3 Januaries. As soon as we did that, you had a buyer's frenzy. We couldn't keep up with the pre-approvals. Real estate agents couldn't keep up with the offers. You're back to multiple offers, tons of competition, home selling at or above list. Now, not like 2020 and 21, but still bonkers crazy, right? So we have 3 years of data point to say, hey, when rates hit this level, the market goes crazy and you lose your advantage as a buyer. So now throw a 5 in front of that number.
Oh, man.
Now what happens? It goes even crazier.
Yeah.
Again, not anticipating a 20 or 21 type of frenzy, but way more competition.
Yeah.
No leverage on the buyer side.
Yeah.
Sellers are going, this is awesome for us, and they can hold their price.
Yeah.
And you're paying $25K more for that house, or maybe 50 more for the house you just got.
Yeah.
And you saved a quarter on the rate, but who cares because you paid 50 grand.
And then also like the not incentives, but the programs like down payment assistance.
Yeah.
Gone. If you're going as an FHA, I don't have to take your stuff. I'm going to go with the conventional.
That's right.
So
your VA contract, you want to take that
versus doing more like a sales market. So
So you lose all of your leverage in that scenario. And the thing that we tell people is, look, none of this, all of that's true. All of that is factual and true. And most people in the real estate mortgage or economic space will agree to it. None of that is a reason for you to go buy a home you don't like today. Right?
Sure.
So, but it's all a great reason for you to be watching and see what's going on, because you never know. Most of the contracts we have coming in right now are people that said, hey, we were just being patient and watching, and then this one came up and we had to have it, and the seller got motivated. So being prepared, being ready to move quickly is a big deal right now, and people should be watching even if they don't pull the trigger.
I love this. The real estate agents watching, take this. October, November, December, and coming into January are the times, and these are the conversations you guys can have to get your buyers to really understand. It's not even just get them off the sideline, just to really understand what's going on and how this can play out for them.
Well, and let's be a financial advisor to them and a fiduciary to them. I mean, if you could save somebody 50, well, let me rephrase that. If you could make somebody 50 grand over the next 4 months, you'd be a rock star. You'd have people lining up to get your advice, right?
Yeah.
So the realtors that are out there watching right now, you're in the position where you can make them $50,000. And that's a hypothetical number, but let's just call it $20,000. Yeah. The amount of money you're making somebody, that's a big deal if they follow the right level of advice. Now, let's finish the thought. So you go through January, like you said, and we think you'll see a little bit of a rate dip in January when we come back, again, for some technical reasons. And then the little blip happens, the market goes a little bonkers for a little while. Mm-hmm. It then chills out in February. So when it chills out in February, that's great and all, except Nate, as a real estate agent, when your seller is going, hey, it's a little slow right now. Should I drop rates on February 15th or February 20th? You're going to say, hey, the buying season kicks off in like 3-4 weeks. Let's just hold because you're going to have a lot more buyers in the marketplace, right? So now that seller doesn't have the same motivation that they do today when they're staring at 3 or 4 months in a row of slow buyers. Yeah. So even then you have to be really cautious. I would say you've got this window probably through January. And then once you get into February at some point,
we don't know what happens.
That's right. And all of you guys are going to say, hey, let's wait till we see the March buying season kick off, right?
That makes sense. So I had a lot of questions from clients like, hey, man, so what's the big difference between I bank with Chase.
Yeah.
Why can't I just go to Chase to see, what they can give me versus going through a Supreme Lending?
Jason loves this question.
Yeah.
Hold on, wait. Where's the soapbox?
Yeah.
Where's the soapbox?
I've had that conversation probably 4 times last week. It's like, hey, why should I? They have my savings account. They have this. I have that.
Yeah.
It just makes sense. They have my credit cards. I go with, Wells Fargo.
Yeah.
And so if you can kind of
So it's a great question.
Yeah.
And of course we're being recorded. So I have to be careful how I answer this. But so the first thing I would tell people is, and this you mentioned Chase. We're not just going to pick on Chase.
Yeah.
This is truly all the big box banks, right?
100%.
So here's what people need to understand about that space. Number one, they're really good at a lot of things. I have Chase credit cards in my wallet right now. They're fantastic in that space, right? And I would say, specifically talking about Chase, they're the better of the big box banks to go to. But here's the key, and I think a lot of people don't understand this. Whether you're talking Chase or anybody else, we'll throw them all in the same bucket. Their existence is there to get your deposits, right? And then sell you products that make them money. Well, of those products, mortgage tends to cost them more to originate, and it tends to cost them more to hold, and it ties up a lot more capital. So the reason they offer mortgage, because it doesn't make them as much money as all those other things we just said, is they offer it because if they don't, you won't give them your credit card and your car loan and your home equity line of credit. So they offer it as a service to you and I as the client, because if we don't, they'll lose other business.
They want to be full service.
Yeah.
That's right.
Yeah.
Now, in order to make it profitable, though, because it is hard to originate mortgages, it is expensive to originate mortgages. It's actually cheaper for them to buy the mortgage that I originate than it is for them to originate their own.
Oh, wow.
So because of that, what they're doing is they're putting mortgage departments in place that are uber efficient from a profit standpoint. And when you do that, you're scrimping on something. And in general, you're scrimping on the amount of people you need, the amount of well-trained people that you need. You have to go out and get fresh people and teach them your way of doing business. And you have to consolidate your operation centers into a few hubs around the country. So the net effect of all that is you've hired a ton of great people, and they are fantastic people, but they may not be the most experienced mortgage people, which means that they don't foresee all the little things that you and I know can come up in the transaction. And when those things do come up, they don't know how to fix them. And so now all of a sudden you have a little bit of chaos on 20 to 30% of their business, right? And forgive me, that's just an example. It could be more or less, right? So from the consumer standpoint, I can go through all of that. And if I am an ace of straights and flushes consumer and everything is perfect in every way, shape, or form, and everybody works on my deal who knows what they're doing, it's probably going to be a great deal for them, for that consumer. But on the off chance that something's a little out of whack, then it's going to be a difficult transaction for them because they're not really going to the best place for that mortgage origination. You'd be better off to come see one of us, go to an independent mortgage bank like what we are, one of the top 15 in the country, and get people who are professionals with a tenure behind them who understand all facets of mortgage and can work with you to get past any shortcomings you might have, originate your deal without any drama or fuss, and then let us sell it to Chase. By the way, you can't tell me to sell it to Chase, but the reality is when we do sell loans, we sell to all the major servicers across the country. And so back to kind of wrap this thing up, you said you're a Chase client, you have your checking with them, yada, yada, you like them. Well, when Chase comes in and looks at a portfolio from an independent mortgage maker, they'll filter for their current customers and they'll buy them. If that's a mortgage that they want, they'll buy it because they want to keep you in the loop for all those other products, right? Yeah. So now I'm not making any guarantees that if I close your loan today, it's going to get sold to Chase and everything's going to happen.
I think Wells Fargo is the number one servicer in the country, right?
Wells Fargo is one of the biggest servicers in the country. Actually, there's several that are probably a little bit bigger than Wells, but they're one of the better known ones. And the thing that people don't understand, I mentioned a minute ago, Wells and Chase and all these guys, they're great at servicing. They're really, really good. They put a lot of money and effort and resources into servicing, but the origination channel gets shorted on the P&L side. And so ultimately, you're probably better to come through us and let us sell you off.
I love this. Like that. Can I piggyback on this, please? Yeah. I wasn't going to say anything, but I feel compelled. I really feel compelled.
Remember, we're being recorded.
I know. We're going to be nice. And that was such a great and astute explanation on the differences, and I love that. And one of the things that, I think we've talked about this just the other day. I think it's in terms of the way that we help our clients from beginning to end is just different, right? You're not calling an 800 number. You have, whenever you're working with Jason or I, you have our direct cell phone number. And this is not an advertisement to come work for us. I'm just kind of telling you the differences, right? Between the big box people and us. Nathan can call me on a Saturday afternoon and I'm going to pick up. He can text me at 8 o'clock on a Friday night and I'm going to text him back. He can call me and I know exactly who's calling on my cell phone versus calling an 800 number. And I think these are the things whenever people do shop us, right? I think these are the biggest differences. It takes them 30 minutes on hold and going through the menus, click one, I need an agent, and then they need to provide the loan number. Well, I think that is the biggest differentiation I've seen so far is when people talk to us versus Wells Fargo, they're just like, well, you picked up on the second ring and I didn't have to go through a menu. And wow, I texted you on Saturday and responded. That's big for people. Just a personal touch.
And throw a 60-second deeper dive on that. So what a lot of people don't understand is the operations teams that process and approve these loans work hand in hand with the sales teams, which go out and set them up and originate clients, which is us. So at a big box bank where you have a regional underwriting center in Des Moines and you're originating loans in Dallas, you may not know any of the people in Des Moines, right? 100%. They're all great people. It's a great place, by the way. Des Moines, super cool place to go hang out if you haven't been there. But you don't know them and they don't know you. And so what they're doing is kind of following the electronic chain down to let everybody know they have a problem. problem. Well, it might be 3-4 days before the originator gets that information. And by then it's the telephone game. It's gone through 4 different layers of people. So the difference in an organization like ours is our people stay with us long term, where we become family essentially. And so they'll pick up the phone, an underwriter will pick up the phone and call us and say, hey, by the way, Jason, this client has XYZ going on. Can you get an explanation for me so that I can get this fixed for you? And now you get an instant reaction, an instant fix for that situation.
And this is somebody you've done hundreds of loans with, you talk to all the time, you're on email, we've gone to dinner with them. This is somebody that is integrated directly into our business, not just
the average tenure in our office is like 12 to 14 years with the company and in our environment. And so, yes, 100%. Our closing team, our underwriting team, our processing teams, they either work for us and have been here for that length of time, or they work with us and have been here for that length of time.
Our operations manager is your wife.
She is
the boss.
She's actually the boss. Yeah,
the real boss.
She's the real boss. I just play one on TV. But I think that's a big piece, right? Not just you can get a hold of us, but those people can get a hold of us like that and fix your loan. And that's what makes us better at problem solving than some of the other guys.
Yeah, because on my side, it's like if I'm showing homes on a Sunday, right, and my buyers like it, I can call Nishant, hey, I need to buy approval for this. Right. Boom. So it makes my side to transmit it to the buyer a lot better, a lot seamless. Because I'm acting as an advisor and as a person who's guiding through that whole journey. Yeah. And so that's like that experience, that taste in them. I was like, hey, I want to deal with Nathan. I want to deal with Nishant because, I spent half an hour on hold with Wells Fargo. Yeah. I was told, hey, can you please hold on again? And then again, wait another 20 minutes. Yeah. Versus here, it's like, bam.
Well, and how many times have you needed that pre-approval letter on a Sunday and they've got a box bank behind them and you're going, well, we'll have to wait till Monday. Yeah. And now you can't get your offer.
And I've heard so many times agents are now really saying, we talked about this the other day, the first offer is the best offer.
Yeah, that's right.
And we're not even talking about the money. It just gives you a certain amount of leverage to get the deal done for your client, right?
Yeah,
and so, but if you're not the guy that's submitting that offer on Sunday night because you don't have what you need or your client has a question, you're not going to be that first offer.
We can do pre-approval letters from our cell phones nowadays.
That's
amazing. I can't tell you, almost every Friday, Saturday, and Sunday night, or at least one of those nights, I'm getting a text message at 8:00 going, I need an updated pre-approval letter for an offer. Got to get it in. Yeah. And I pop out a cell phone and I do it in 3 minutes and it's off, right? And that's a different level of service than what you're going to get out of other organizations.
So, if for the average consumer who's watching this, when they go talk to one of you guys, right, what are the things that they need to have in order to make sure that puts them in the best position to be approved for a loan or to increase their purchasing power? What are the key items that you guys look for so they can already start planning to put themselves and set themselves up for success?
I'll let you take that one to start with.
Number one, we love to have these conversations early, right? So it always puts the client in a little bit of a precarious position if they're calling us on a Friday afternoon and they're going to go fall in love with the house on a Saturday morning, right? Because they may not have the things set up. Like, we're going to need pretty standard things in terms of the industry, right? We're going to need bank statements, tax returns. We're going to need to figure out what their debt to income ratio is, how much they're bringing in, how much is going out, how much debt do they have, these very standard normal things. Yeah. And so what I would advise anybody is just to have these conversations, even if you're not ready, even if you're not looking at houses yet, have the conversation with us a month, 2 months, 6 months before you guys think you're actually going to go out there and start looking at houses. Because if you're not ready for whatever reason, we can set you up on a plan, right? We do this all the time.
Absolutely.
We set up, say, hey, you know what? You have maybe a little bit too much debt. So we actually have an amazing sort of simulator available to us. Where we can plug you into the simulator and say, well, if you paid off this credit card by X%, if you paid this off, fully, we're going to basically help you to maximize your credit score to get you guys ready for it.
Which gets you, by the way, the best rate, the best fees,
get you the best
loan program.
Absolutely.
So it's more of a financial planning event in a lot of cases than just a transaction. Mm-hmm. And so all of those things that you just said are super critical. But the reality is it all boils down to, and if you're a consumer listening to this right now, you're like, well, I don't really understand. How does that affect me? All right, well, it affects you because you reach out on Saturday morning, to your point. They saw the home. It's beautiful. It's amazing. And then boom, there's that one stupid thing from when you were in high school on your credit report that you didn't even know was there. And you have a 580 credit score. And we're going, well, you can't make an offer on that home today because we have to fix this.
Yeah.
Even if I can fix it in a week, someone else has had a chance to make an offer on that home in that week and you lose that house. So starting that process early and not waiting until you found the perfect home is critical. And if you just have general information, income numbers, who you are, where you live, where you work type of stuff, we can take care of you in less than an hour.
That's amazing.
Yeah.
Well, I think that kind of wraps it up for there.
Yeah.
Right? Yeah.
First of all, Jason, thank you so much. Do you have anything to basically say, like to wrap this up in terms to an agent, to a regular consumer, to the public about the Fed rates and how that works? I mean, you've done a great explanation, but is there anything that you'd like to say to wrap it up?
You know, a couple of quickie things. I want to make sure everybody understands we're still in a really great market to buy right now. Yeah. And I think regardless of what the Fed's doing and regardless of what the economic data comes out as, the U.S. economy is super resilient. And because of that, you're going to see home prices continue to appreciate a little bit. You're going to see home sales continue to happen. Really, the best thing you can do for yourself in the future is don't get caught in the weeds with what's going on with interest rates and Fed and all of that stuff. Make sure you're prepared and ready to go, and then be watching for the right house for you. And all of that could happen tomorrow, or it might be 6 months from now, but be ready, be prepared.
I love it. Jason, thank you so much for your time.
Sure.
I really appreciate it. I think a lot of people learned a lot of stuff today, right? Like these are not things that you're going to find on TikTok or Instagram. I've seen quite the opposite, or even in our own hallway at a real estate office. I think the misconception is prevalent across the board for a lot of people. They just equate the Fed cut to mortgage rate cuts. And cars are cheaper and houses are cheaper and everything's cheaper. So we really appreciate the time.
Sure, you bet.
Cool.
Thanks, guys.
Thanks, y'all.
Thanks, guys.
Bye now.